Ghanaian Parliament has passed a number of tax bills into law. These taxes are expected to run for a period of 18 months while government closes budget deficit gap, that of course within the country. However, some analysts have called for consideration as these taxes could impede growth and expansion for companies. Let's get into this now and of course understand the rationale behind government's move. We've got Ayi Ayita, Deputy Commissioner of the Ghana Revenue Authority. Thanks for joining us today. So let's get into the, I suppose, I mean, this is a short-term measure right now where you're looking to help smooth the country through a period where it certainly needs a fiscal boost right now. It's an 18-month period you've introduced these taxes. So give us the kind of snapshot view right now from the government why you've chosen to go the tax route.
Thank you very much, and good day to your viewers. Let me state categorically that the number of taxes that have been passed recently are not all for 18 months period. It is only one of the taxes passed, the National Fiscal Stabilization Levy, that is legislated to run for 18 months. All the other taxes are amendments of existing taxes that sought to clarify in some cases ambiguous provisions in previous laws and then improve implementation. But in terms of an 18-month duration for a tax, we are talking about the National Fiscal Stabilization Levy, which is that period.
So there we go. So that is clarifying that, but I suppose it makes sense to call it the National Fiscal Stabilization Levy for that 18-month period. But ultimately what it does do is it increases the effective tax rate for corporates. I mean, you're targeting, issues, you're targeting products rather, energy-saving bulbs, book binding machines, farming inputs, agricultural products. So it's across the board right now. So ultimately, are you concerned around the impact that it could have on corporate earnings and the impact that could then have on their ability to then grow and help boost the economy?
To be exact, the National Fiscal Stabilization Levy mustn't be confused with the Special Import Levy, which is an amendment of an existing tax. The National Fiscal Stabilization Levy focuses on or targets specified industrial sectors. And such persons will be paying a tax of 5% of their profits before tax, in addition to the normal tax rate that they have. It is industry specific rather than product specific, and that's the tax that is running for 18 months from the middle of this year to the end of next year, and that is a fiscal stabilization levy. There is, however, an import surcharge which has been imposed that's running on all imports with some exceptions, a few exceptions, and that is at ranging between 1% and 2% of their CIF value. The two are separate laws which are currently in operation.
You're also looking to implement a tax on those who are renting out properties because there's been an explosion in construction of residential and commercial property. I suppose Accra is where you're seeing it specifically right now. And according to reports, minimal revenue collection from the property sector. So tell us about the implementation of these new rent taxes in the country.
The initiative on rent tax isn't a new law. The rent tax as a subject of charge has been in the tax laws all along. Collection hasn't been very encouraging, largely because the rent tax itself, to a large extent, is a self-assessing tax. What the GRA has done a few days ago is relaunching the implementation of enforcement of collection with a combination of seminars, workshops, educational programs, as well as some level of enforcement. Taxation of rent income has been in the Internal Revenue Act for quite some time. Our law categorizes our incomes into three generally: income from employment, from business, and from investment. Rent forms part of the income from investment, and it is taxable either as business income for a real estate person who is engaged in the business of rentals, or it could be a one-off tax on property owners who give out their taxes. So what we are doing is re-emphasizing, refocusing on the issue of collection of taxes or rents so that we improve the overall collection of that tax type.
The special import levy has also been introduced. Is that to protect local producers in the country? What's the thinking behind that, and how much money do you think that you can generate through that?
The special import levy, I would say, is a new one, and it's computed at between 1% and 2% of the CIF value of some imports, with a few exceptions. Yes, I would say that is also something new. Interestingly, the law did not give a specific period that it would run, unlike the National Fiscal Stabilization Levy, which is clearly running for 18 months. But what it certainly means is that for those products that didn't earlier on attract that type of tax, there will be that tax as an additional impost on them.